Hey there, Adam Gower here, and this week my guest is Daniel Cocca, who is co-founder at Alpha Investing. Now, Alpha Investing have developed a really fascinating business model. Their model is really not very different from the way that private equity real estate shops operate, in that they go out and find sponsors who they have confidence in, do due diligence, and then assign capital to those sponsors. Now, the big difference is, of course, that typical private equity companies, at least the ones that I've worked for, will source their capital from institutional investors. Whereas what Alpha Investing do is they source it from individual investors. It's a very interesting approach to real estate crowdfunding, and Daniel and his colleagues have done an exceptionally good job of it. Find out more about Alpha Investing and Daniel at gowercrowd.com on the podcast page, where you will also find top right on the page our brand new news section. Go ahead and click on that. Be sure to subscribe. It's totally free. There is a premium version, so give that a whirl if you're so inclined. The channel is by far the most comprehensive source of news, information, and updates on the commercial real estate crowdfunding industry anywhere on the web, all there at gowercrowd.com. Now, one of the reasons that I particularly like my conversations with Daniel, who you're going to hear from today, is that he loves the topic of behavioral economics, or what I would call behavioral psychology, actually, the way that people interact online and what triggers actions for them online. He has some very good suggestions for books. He's a very interesting fellow, and you're going to learn a lot about Alpha Investing as well. Well worth the time spent today. Here he is, Daniel Cocca, co-founder at Alpha Investing. Daniel Cocca, Alpha Investing. You've got all kinds of founder, general counsel, all kinds of titles over there. I got to ask you a question. It's been ages. I'm so happy that we can catch up and that you're willing to catch up with me on a recorded podcast, crying out loud. So my first question. Last time I spoke to your team and said, how can I bring you more investors? You said, we stopped taking investors. Who in the world says no? You're the only person in the entire country that says, sorry, we're not taking it. So what's been going on since I last spoke to you? That's an extraordinary position that you're in. Tell me all.
Yeah, I mean, listen, we haven't gone off the rails. It's part of an intentional approach that, we've been kind of developing over the years. But I think it really goes back to how Alpha started. It was a group of us who were all pretty busy working professionals and investors. We wanted to deploy capital into, institutional quality real estate. And at that point in time, before the Jobs Act, before crowdfunding, before like all this access, it was a really hard thing to do, especially if you were an individual that wasn't writing 7-figure checks into transactions, right? And we know that to be true because when you look at the data, if you outside the 1%, top 1% of earners, the percentage of real estate in any given person's portfolio, like effectively rounded to zero when you exclude the value of the primary residence, right? And so it was a hard thing to access. And we wanted to create something that felt like an optimized investor experience for us, right? And, we set out and, of course, trials and tribulations and things we learned and things we did wrong, but we set out to build something that, we could access as individuals and get into institutional quality private real estate deals. And I think over time, you get to a point where you have to make a decision about which direction do you want to go, right? And for us, the idea of having tens of thousands of investors fundamentally changes the core values upon which we kind of built this company, right? And now we have to acknowledge, of course, that having more investors or investors that are deploying more capital is a valuable thing, right? But we also want to be able to develop real relationships with the people in our network, right? Everyone who's part of Alpha has spoken to one of the principals of the firm, has multiple points of contact. And I don't want to say I'm best friends with everyone in the network, but we know everyone, well enough to understand what their real estate goals are, what they do, what they actually care about. And they know enough about us to understand what our strategy is, what they should expect to see from us, how everything works, et cetera. And so that's a really important, I think, part of this whole thing. And then, in practice, what you have to also appreciate is that the type of operating partner that we're trying to work with, they in a vacuum do not need us to raise capital, right? Like they have $1 billion plus portfolios. They've done it before. If they've performed well, which they have, if we're talking to them, they can raise equity capital. And so that's not the type of group that's interested in blasting their deal out to tens of thousands of people, right? And so part of the way that we kind of improve or keep a high quality partner within Alpha is by keeping this small network. And we arbitrarily decided that was 1,000 people. And, we'll see if that ends up being the case. I think we're at about 850 active investors in the network right now. And so we are letting people into Alpha still. It's just on a very selective basis. And the reason why, the reason why that's important, because I do want to clarify, the reason that's an important part of this thing is that the SEC 99 investor rule, right? That limits the number of people we can bring into, most of our offers.
Are these
right?
506Bs then that you're investing, not Cs?
They are. Everyone goes through a pretty comprehensive onboarding process before they join up with Alpha, right? And so because that's the case, and there is demonstrable value in being the majority equity partner in a deal, or at least being a recurring larger equity partner. And that might mean being able to negotiate better investment terms. It might mean just a right of first refusal on X or priority access to new deals, what have you. There is value to that. And so the people we're letting into the network today have the ability to write six-figure checks, multiple times a year. That benefits the entire network. And what it doesn't do, because we have a ceiling, is create undue competition for equity, right? Because you know how it goes. You have a new project, everyone wants to get in. I don't ever want to have to make the call or send the email saying, hey, sir or ma'am, I know you wanted to come into this deal, but we just don't have room for you, right? We want to make sure the people who are part of Alpha from the very beginning, the people who really put their trust into us before we had built the track record we have today, they still get access to our deals and they're not getting pushed out. And so that's a really long way of saying, it was intentional. I know it sounds crazy. When we talk about it as a team, we oftentimes joke, what are we doing here? Right. And maybe it's a long con on us where we tell everyone we don't want investors and then, we get a ton more, because that's effectively what's been happening, unfortunately. But it is true. We're trying to keep things at a scale that we think makes sense for the folks in the network today.
Well, I have to tell you, I actually, I think you are perhaps, I don't know. I think it's genius what you do, because what you actually stimulate is this. As soon as you put something out in front of somebody and say, here's something really fantastic, and then you take it away, that's what makes people want it all the more. It's a psychological reaction. I always thought actually that it was I actually know that it was never a conscious decision for you to do that, but I do actually point to you as a poster child for that, because I know that on your website, it says when you go to the Invest Now, you say we are very selective in who our investors are. And I always suggest to sponsors, you might want to think about, maybe putting that kind of barrier in, because the better at what you do as you are. Well, that's completely wrong grammar, but the better you are at what you do, the more people want it. So if you do make it difficult to get, that just makes it even more desirable. And that's actually what I always thought was part of the principle behind it. But let me ask you this question. Institutional quality real estate. And I remember talking to Fark about this years ago when we first met. What exactly does that mean to you? Institutional quality real estate?
It's a good question, and it's a moving scale for all different types of people, right? And when we first started, we thought about it, portfolio and kind of track record size. How many deals have you done? How many have been realized? And we just kind of went through a process of saying, somewhat arbitrarily, but with some knowledge, hey, this is the line, and this is a group that has enough experience that we feel comfortable they can navigate a good market, a bad market, whatever kind of comes their way, they can figure it out. And I think that's a really important part of investing into real estate, is just minimizing variables, right? And execution risk is a big part of that. And so whatever you can do to minimize it makes sense. But I think as we grow as a team internally, especially as we've grown out our own internal asset management team, we feel more comfortable getting involved in the weeds in a lot of the deal processes. And so there are scenarios where there might be a smaller group or someone from a larger, very established group who's going out on their own and they've only acquired 6 or 7 properties under their own umbrella, but they have a really demonstrated track record of success. And then qualitatively, as we evaluate them over a period of months, we say, hey, we've been searching for reasons why we shouldn't invest with you, and you just haven't given us one, right? And because of that, we've never been a group that like trusts our gut, so to speak. Like, we really want to, but it's always let's verify over and over and over and over again. And eventually evolves into more of a, hey, like we've bounced every possible scenario and run every test through this group, and they haven't given us a reason to say no. And so now we feel really comfortable saying yes, right? So a long answer to your question, it's a moving target for everyone. Just looking for smart groups with good strategies. And when you ask them a question about why they do X, they know why. And you ask them a question about their portfolio, they know why the portfolio is performing in the way that it is. It's not just, hey, we're buying real estate, come on board. And so not the best answer to your question. There's a lot of factors that go into it, but at the end of the day, that's how we think about it.
Yeah, but there's more to it, isn't there? And you've already touched on this. And that is this aspect, when institutions, so this, I was just talking about this before, institutional quality real estate, of course, is the real estate itself, the caliber of the sponsor, and the scale, right? It's the scale is a large part of that. But the big differentiator is when an institution invests in a deal, the extent to which 2 things happen. One, they do due diligence and analyze a deal. That's institutional quality. And the second is, and you mentioned this, and this was actually something I had a deep, long discussion with Art 3-4 years ago, is the extent to which you negotiate rights when you go into the deal. Those are really differentiate. Those are clear dividing lines that individual investors simply cannot get or implement. You can't do a property condition report, right, on a building. If you're, investing 25,000 or even 100,000, could cost you that to do a PRC on a deal, for example. Maybe not that much, but to do all the due diligence. So that's really a differentiator, isn't it? That's the value, the added value that you bring is institutional quality, underwriting, analysis, and negotiation.
Yeah, the control rights are key, right? And it's only over the last few years that as a network, we've gotten to the point where we're now the majority equity partner. And so, we can have those control rights. And that's an important part of just how we've strategically grown the network, right? But when you have control rights, what you then also have to make sure you're doing, and this is part of the reason why we built out our kind of internal asset management team, right? Is you have to be on those weekly or biweekly property management, update calls. You need to be looking at monthly financials. You need to understand at the same level the sponsor or operating partner does what's happening at that deal, because at some point down the road, you're going to need to vote yes to a sale or a refinance or some other major decision, right? And there are different levels of the control rights spectrum, right? That one of the challenges that we hear from a lot of our operating partners is the largest institutions, the ones that are deploying billions of dollars into private real estate annually. Their control is very, very laser focused. You want to put up new rims on the basketball court, somebody's signing off
kidding.
on it. And that presents challenges, right? When you're trying to manage a property and then also manage an investor. And so we tend to focus on the major decisions of things that are important. And then we also just know we have influence over the transaction because we're a recurring capital partner, and that's just how these relationships build.
I was going to ask you now, I have to ask you, so I sent you an email, you kindly reminded me of, I told you about my memory like memory like a steel trap. I supposedly it keeps everything in, but in my case, only can keep one thing at a time. Results, you just delivered a 100% IRR on a deal. Please, do those really exist? Tell me about that.
It's funny because I just watched this documentary series on HBO about this elusive 100-foot wave in Portugal, and that's what I feel like the 100 IRR deal is like. But throwing my lawyer hat on for a second, which I fortunately don't have to wear that often anymore, what happens in the past is not necessarily indicative of the future, and there's a lot of circumstances and context around, what creates a 100 IRR deal. Part of it is the shorter hold time. This is a deal we flipped in and out of in 12 months. And so investors got a 2x on their equity, but it's very different than having 100 IRR over a 3, 4, 5 year hold, right? And then, the deal benefited from close to perfect timing, right? It was purchased, last October. I think it was a going in like 5.3 cap, which, in
multifamily deal.
Yeah, workforce value add multifamily in Phoenix. That is not a cap rate that you will see today by any means. And so there was a lot of value created. I think we improved NOI at the property by about 30-35% in that 12-month period. The asset value increased, I think, something like 65 to 70%. And so, a big chunk of the return in that case, nearly 55% of it, was market-driven appreciation, right? Cap rate compression. And that's not something we ever underwrite. We actually underwrite the opposite. We always assume pricing trends are going to go in the reverse. And our threshold is usually about 200 bips of cap rate expansion on a 3-year hold.
That's incredible.
And we look at things like a matrix, right? And there's 2 parts to that matrix. One is execution-driven value, meaning we renovate units, we increase rents, we improve NOI. And the other column is market-driven appreciation or cap rates compressing. And so if a deal makes sense when you underwrite 200 bips of cap rate expansion during the hold period, and personally, I don't believe that's going to happen, but in a world where it does, you still get that mid to high teens IRR, and every investor should be not just happy, but ecstatic with those types of returns, especially if they're getting them, on an annual basis. The last 5, 7, 10 years have really created a benchmark in an environment that is a little bit crazy at times, but nevertheless, people should be happy with that. But in a world where cap rates stay flat, maybe they increase marginally, or, they continue to compress, like a lot of people think will happen. That's where you see that, outsized return come from, right? And so what we really care about are another deal we did with that same sponsor, which, we bought in 2018 and sold in 2020, early 2020, I believe. That deal sold, the asset value, I think, was about 50% higher at sale. It was held for maybe 18 or 19 months. But out of that 50%, 40% of it was an increase in NOI, right? And so in that case, 80% of that return was execution-driven improvement to net operating income. And that's a really important thing to understand, because 100 IRR, and in that case, I think that deal is a low 40s net IRR to our investors. Like, those deals in terms of execution were actually somewhat similar, right? I think they beat their pro forma rents by anywhere from $50 to $70. The deals, performed well by any means or in any market, but it's the cap rate compression on that deal that led to that, monster. I think it was like 104, net IRR. Please don't ever expect that to happen again.
Yeah, in fact, let's talk about it, because that's a big problem. You deliver that kind of returns, and you can habituate. Well, no, let me rephrase that slightly. Actually, investors, especially those that have been in the market for long enough, they anticipate returns that may not necessarily be realistic in a market like we have today, that's full of liquidity, potentially overheated. How do you deal with that? How do you explain to investors? How do you articulate that what you saw yesterday? And you already kind of use this as a provisor, right? Past returns, nothing about the future, blah, blah. But I mean, realistically, that's the case, right? Investors are used to higher returns. How do you sell deals in a 3-cap market, for example?
So it's a really good question. I think there are a couple parts to it. One, and this is part of the practical business point behind why we have a smaller network, is that it's much easier for us to communicate things like this to a group of 800 to 1,000 people than it would, 20 or 30,000 people, right? We can spend the time getting on the phone, having real conversations with anyone who wants to in the network about, how we view the current environment, what their return expectations should be, et cetera, right? Now, fortunately, a lot of these people have been investing through multiple cycles. And so they know there are good times and bad times, and they come and go and what have you. But you're right, it's a behavioral economics question, right? You throw massive numbers in front of people, you set a massively high benchmark. All of a sudden, they're disappointed with what would otherwise be, a really strong return. And so there's no way to stop people from feeling the way that they feel about the return expectations, right? We just try to make sure we educate people. We write a lot of kind of quarterly, what we call alpha insights. We do a lot of white papers where we talk about our strategy, just try to get everyone on the same page that we are, right? At the end of the day, it's an exercise in investor education. I know this is something that you do a lot of as well. And so we're just trying to kind of share, our version of what we see in the marketplace, and, hope that people understand. And then, of course, we put a ton of qualifications on things, right? Like I'm, as you can tell, the type of person who I'm going to lead with, this is why what I'm about to tell you, needs to be qualified, by whatever, proviso you want to add in there, right? And, as an individual, I am not a huge fan of investor protections, but based on my training as a lawyer, I realize they're really important, right? And it's because there's these types of opportunities for investors to behave in a way that's irrational, like the benchmark effect, as we call it in behavioral economics, that you sometimes need some amount of regulation, right? To make sure that there aren't groups out there that are, taking something that happens and presenting it in a way that is misrepresentative. And I'll tell you, and I'm sure you're on the same emails that I am, see a ton of deals coming from a ton of different people that I've never met before in my inbox. And a lot of them more recently have been, this is a home run deal, invest now, limited spots. They play on all of those behavioral economics marketing things that get people to say, I need to invest right now. If I don't say yes in the next 3 hours, someone's going to get my spot and I'm going to miss out. And that's always problematic to me. And it's not a direct answer to your question, but the point I'm trying to make is that you got to choose your lane, so to speak. And we've chosen the lane where we're going to err on the side of being very conservative and overly transparent.
You have actually not only answered my question directly, but segued into exactly the point that I was trying to make. And so let me ask you this way. So how do you compete with that? I mean, there's two types of people that are doing that, right? There are those that are exceptionally good at triggering psychological responses in prospects, but who don't necessarily really understand what's going on in real estate, right? And so it's a major hazard. Then you have legitimate sponsors who've worked hard, are still working hard, and they understand the business, but they also understand that if they don't fly the high return flag, they're going to lose a lot of opportunity with investors who are gravitating to, that which glitters must be gold type of returns. So how do you deal with that? It's actually conversations that I've had with other folk who are like you, who are conservative. How do you deal with that? How do you explain to an investor who maybe isn't sophisticated that the highest IRR doesn't necessarily always win?
Yeah, I think it's an important point. An important thing to note is that we don't view ourselves as competing with that type of group, right? And if you're part of Alpha and you pay attention to what we're doing and what we're writing, you should hopefully be able to recognize those things pretty easy, right? And yeah, that's just kind of a big part of it. We are not trying to play that game, and that's why we have a smaller network, because it's easier to ultimately communicate those things, right? And in a vacuum, we even know internally, right? Throw risk to the side. If we put a deal up that has a higher IRR, everything else being equal, there will be more interest from our investor network in the higher IRR deal, right? People as individuals do not do a great job of making investment decisions on a risk-adjusted basis, right? And that's part of the role that we play in this process, right? Because we're going through the exercise of flying out, touring the property, touring all the comps, making sure that the business plan is actually feasible, that there's a substantial amount of downside protection. And so when we share a deal with our network, we already believe internally that the deal makes sense on a risk-adjusted basis. And investors get to choose which deals they do or do not want to participate in.
Daniel, so where are we in the cycle? I know that's like asking you to gaze into a crystal ball, but what does the market look like to you at the moment?
Yeah, so my crystal ball has regularly been wrong, particularly as it relates to real estate investing. The good thing is my crystal ball or our crystal ball tends to err on the conservative side. So being wrong is not necessarily a bad thing, right?
You missed it rather than
exactly. But if we were sitting here in 2015, I would have been telling you about how important long-term fixed rate debt is, right? And then we have 7 out of 8 quarters with interest rate rises before that, and we all of a sudden we're living in a completely different world, and we feel very differently about things. And the deals that have long-term fixed rate debt, we're frustrated by because they've got prepayments and we want to get out of them, and that's how it goes, right? And so since 2015, we've been talking about downside protection, need-based residential assets, removing or minimizing variables, right? That's why we historically have not done much that has a commercial component where consumer behavior has really any impact on what we're doing. And that's not because we predicted COVID. It certainly isn't. It's just part of the strategy is let's minimize the variables that we can, and then try to make bets, so to speak, on the areas that we feel confident in, right? And so that's kind of ultimately how we got to that point, right? And I'm rambling now because I feel like I'm kind of like
asset.
I've gone on a tangent.
Let me help you out.
No, yeah, please.
I love talking to you, Daniel. You're always so interesting to talk to, and then suddenly you stop and think, oh no, what am I talking about? So, asset classes. Tell me about asset classes, because I know that you've looked at a few and you're into a few. So, what's hot today? That's so makes it sound a bit sensational, which I know you're not. To tell me about
I get it. So okay, I think our investments fall into 3 buckets right now, right? One will be your value add workforce multifamily, and that falls into kind of 2 sub buckets. One will be the demand market, like a Phoenix, where you're buying at very low cap rates, sub 3.5 in many cases. Right. But there is a business plan where you're going to get rent increases, and the ability to create value exists such that buying a 3 or 3.5 cap deal can make sense. Again, in so much as you believe there's downside protection, your coverage ratio makes sense, and the business plan is achievable. We want to look at the comps and say, we know how we're going to renovate this property. We know what it's going to look like upon completion, and if at the end of the day it's going to look better than other properties who are already getting our pro forma rents, that makes us believe that the business plan is achievable. And in a vacuum, and I feel like I've been using that phrase a ton recently, but in a vacuum, right? There's just been a ton of capital, and this isn't something the listeners don't know, that's pumped into the economy. And even if it gets into the hands of the people who need it the most, it eventually trickles into the hands of the wealthy. And that's what's led to all this asset level inflation, right? And so even though we've been very concerned about the downside as we've made investments over the last 5 years or so, we do have to acknowledge that assets should continue to appreciate. If that's another 2, 3, 5 years, it's hard for me to say. Depending on who you speak to, you can hear a wide range of thoughts there. But generally speaking, if a deal has strong downside protection, the business plan is achievable, we likely want to own that asset. We want to be asset owners in the current market, right? And so we look at some of that, workforce value add and demand markets that has a ton of the value creation story. And then we also like the smaller secondary, stable tertiary market, maybe where you're buying 150 unit multifamily class B, and you're buying it at north of a 5 cap, right? So your margin for error is a little bit higher. You don't need to get $250 rent bumps in order for the deal to make sense. It cash flows, better in the early years. We like those types of deals as well in the multi space. Again, Class B is interesting because regardless of the economy type, someone's in class B, right? C moved to B in a good economy, A moved to B in a bad economy. There's always somebody there. Again, minimizing variables. That's an area we like. We've historically and will continue to do a lot of senior housing. Right. It's mostly been assisted living and memory care. And, for obvious reasons, we haven't acquired any properties over in the last 14 to 16 months, something like that, right? But if you asked me 6 months ago, I would have told you, and this is before the Delta variant became a real issue in that space, I would have said, we're looking at an acquisition-rich environment over the next 12 to 18 months. It's a very fragmented asset class, tons of mom and pop owners who have their entire retirements tied up in one or two assets. And even if they didn't have COVID cases or deaths, they had to deal with the rising labor costs, right? And that put a lot of pressure on the mom and pop that an institutional manager like the one that we acquire assets with, didn't experience to the same degree, right? Of course, the portfolio took an occupancy hit during COVID, but it's bounced back, pretty quickly, and we're kind of comfortable where things are, and there's still some room to get back to pre-COVID levels, but we're well ahead by, I think, about 5 percentage points on occupancy over the rest of the market, right? And so we're expecting to see opportunities there. It's an asset class that most operators are on the ground up side in an effort to deal with the supply-demand imbalance as baby boomers head into those facilities. The group we work with focuses exclusively on acquisitions. There's a limited universe of buyers in that space. And so we tend to find really interesting high 7, 8, 9 cap rate acquisitions that will cash flow in the high single, low double digits right out of the gate. And then also have some upside as part of this larger portfolio we're building. And then the last area that we're deploying capital in right now is a single family rental space. And it's relatively new for us. We just started this year. It's an asset class that we've been talking about for years. The challenge is, as an individual group, it's a really hard thing to do, right? And anyone who's ever owned a rental property knows you go out and you buy it, it's a ton of work, what have you. It's really important to build scale in whatever given market. And so we found an operating partner that kind of fits perfectly into that strategy. And we just love the big picture stats about single family rentals. And I'll throw some of them at you because they were new to me when I first learned them. I guess anything's new to you when you first learn it, but it wasn't that long ago that I learned these stats, right? But I think it's like 53% of the rental stock in the United States is single family housing, with the remaining 47 being apartment buildings. And that's never what I thought, right? I would have assumed that there were way more apartment buildings, right? But despite that, and pre-COVID, only about 2% of single family homes were owned by institutional private equity, right? Whereas if you go back to multifamily, it's about 50% institutionally owned. And then if you think back, and this is before my time as a professional, but the early 90s, multifamily was not seen as an institutional quote unquote asset class, right? And it got there, over time. And our expectation is the same thing is going to happen in the single family rental space, right? And so our strategy is really to buy up very similar types as we do on the multi side. So, workforce value add. We come in, we typically spend $15,000 to $20,000 renovating any given home, and the rents post renovation are typically not exceeding $1,400, $1,500 a month, right? They're very affordable to the demographic that lives in that local market. And then what we'll do, and we're in 2 cities now, about to get into our 3rd city, is build up a portfolio of maybe 1,000 to 2,000 assets, stabilize it across 4 or 5 markets, and then we'll look to sell it to an institution and get that portfolio premium as well. Because what we expect to happen, particularly over the next 3, 5, 7 years, is that what was 1% institutional capital pre-COVID, which is about 2.5% to 3%. The last time I looked at it, 5, 10, 15, 20%, in the next 5 to 7 years. And the challenge is to go in. You can't buy, if you're going to deploy $200 million in the space, you can't go out and just buy $200,000 homes one after another. Right. It's just not a efficient way to deploy capital. And so having a portfolio of 1,000 stabilized assets is a very attractive exit to an institution. And so it's newer in our portfolio of asset classes we invest in, but one that we are very, very bullish on.
What are the biggest challenges that you have today, and then we'll move to 3 sign-off questions. My last question.
Sure. Challenges as it relates to our business.
Oh yeah, just like on a I don't know, on a day-to-day basis from a business. But like, what are you trying to deal with today?
Yeah, so I think it's internally building out like more expertise, particularly at the asset manager level, right? When we first started Alpha, and we were in our late 20s at the time, right? So very naive, needless to say. We thought, hey, you aggregate people, you give them the opportunity to invest with a $1 billion sponsor or sponsor with $1 billion portfolio. That's all that matters, right? Because you're giving them access to something they didn't have before, and bigger is always better, what have you. And what we learned over the years, of course, is like that's not always the case. There are groups that check those boxes and haven't performed. And so having a really skilled underwriting and asset management team is important. We hired my partner, Anne, from AllianceBernstein, maybe like 3.5 years ago, kind of built out our group internally to look very institutional in just in the way that we evaluate new acquisitions, but then also look at the performance of existing acquisitions and then try to apply that data to the next deal we see from that same group, right? And so that's a big part of what we're doing now, is building that out. We obviously are, looking for opportunities to deploy capital in, again, a way or a deal type that has downside protection, but also achievable upside, right? And as cap rates continue to compress, at some point in certain asset classes or deal types, it just becomes less and less likely, right? I don't see a world where we're buying 2-cap deals, right? And it's not all that crazy though, because when you talk to people and investors in other countries, like who want to invest in the US, they often say, I live in, even a city like Toronto, and everything's a 2-cap here, right? And so, the world may go there, but your margin for error is just so low. And what happens on like a value add deal, for example, I think it starts to take the profile of a development deal. You're not going to have any cash flow for 1, 2, maybe 3 years, and you're making a bet on the residual value of the asset, right? And we hope that that's not where the market's going. To be honest, if you ask me, even as an owner of a lot of real estate, for our purposes, I think I'd prefer cap rates to maybe across the board go up 50 bips. I think that would create a nice sweet spot where investors are still generating, really strong high teen, maybe low 20 IRRs when deals outperform, but you still have downside protection on your new acquisitions, right? And so I think those are the 2 things that we think about the most, is how to continue to find deals that work and make sense regardless of the environment that we're in today or maybe in the future.
Fascinating. Just hearing you talk, you're starting to sound like, to me anyway, like a private equity fund that would normally have raised money from institutional capital, raised a $2 billion fund or whatever from institutional partners, and then put it into operators. It's almost the way that this new world of individual investors is evolving. Is teams of pros like you that have the capacity to underwrite, negotiate, know what you're doing, very, very selective on who you actually invest with. And instead of raising money from a handful of institutions, you're raising it from 850 individual investors. Very interesting.
Yeah, I think that's exactly right. We model what we've built internally off of these larger institutional real estate private equity firms. But as individuals, we have a team, I think, of 9 full-time people right now, and we'll probably add 2 to 3 more over the next 12 months. That works for us, right? We don't need to have a 250 person team and be $1 billion shop. And to be fair, if you said to me, Daniel, build me the biggest and best real estate private equity firm in the country, I would be telling you something very different in terms of our strategy, right? We're trying to, again, build something that works for the people in our network because, we know them and we want to do right by them. And it feels good to deliver 100 IRR deals to people that you actually know, or at least better than it does to strangers, right? But that probably goes without saying.
Let me sign off with 3 quick questions. All right, as I do with all my guests. 3 questions. First question: what are the key daily habits that you have that make you successful or productive?
Yeah, that's a really good question. I joke with my wife. I read an article maybe a month ago. Jeff Bezos doesn't start working till 10 a.m. because he needs his morning time, and so I definitely fall into that camp. Fark, my partner, he's a guy who's up like early and he's grinding early. I like to ease into my day, like kind of get myself situated, and I think from a health perspective, sleep and mental well-being are just so important to kind of getting my day off right. And so I tend to work later into the night, but that's an aside. I try to read a lot, whether it's, the Wall Street Journal in the morning or, different, books. I love behavioral economics. One of my favorite, as a reader, one of my favorite topics. I try to read as much as possible. We go through an exercise every Friday with our full team where we go through different like economic reports and letters written by different economists. And we just like discuss them in an open forum for like an hour and a half. And it's a really great way just to get a better understanding of like what's happening in the world, right? Because you hear all these headlines and that's the world we live in, but inflation. And there's a difference between asset inflation and consumer product inflation. And then there's a difference between consumer product inflation driven by demand and CPI increases, driven by supply shortages, right? And so just understanding what actually moves the needle, I think is really important. And then, last thing I'll say, I have a very loving and supportive wife that allows me to do the stuff that I want to do. And given we're catching up, we're having our first kid in March, a boy.
Oh, congratulations.
Super exciting. A mix of exciting and terrifying. But we're getting
Very
there.
cool.
And so, I think those are the things that I focus on. And then I guess as a fourth thing, I'm a guy who's really into the, health optimization world, whether it's how I work out, how I eat. I'm an intermittent faster. I focus on certain types of food. I take a lot of different like supplements and things throughout the day to kind of just help me focus in, right? The thing that's most important to me, put everything else aside, is like how I feel and do I feel productive? And so those are some of the things that I think get me in my optimal productivity state, so to speak.
Fascinating. Intermittent fasting. In my mind, I was just thinking I'm an intermittent eater, but I do know. I'm just joking. Actually, I got to throw in another question here. So there's actually going to be 4, but this one's very quick. So I know you read a lot. I remember you and I talked about that. We actually shared some book ideas to each other. So what book would you recommend anyone interested in behavioral economics? What's your favorite book in that topic? I know it's your topic, isn't it?
Yeah, I think a good starter book is called Nudge, and it's a discussion around the different ways companies, governments, what have you, can nudge people to behave in a certain way, right? And it's just really interesting when you read through some of these things, because they're things you'll recognize from your life, right? The way that the power company sends you the bill, right? And if they focus on the amount of energy you increase month over month and they show you that stat, they find that people will use less energy, the following month, because they now recognize that stat exists. But if they don't show it, it doesn't happen at all, right? And so it's really interesting just to understand, because economics believes that traditional economic theory believes that people are rational, right? And behavioral economics says people are not rational, right? And here are all the different ways they behave irrationally. And I find that just much more interesting to learn about than the traditional school.
Right. Not rational, but predictable.
Exactly.
Yeah. Second question of the last 3. What has been the hardest lesson you've learned in real estate?
Real estate is still the Wild West, right? Particularly private real estate, right? And coming from, the background of being a capital markets lawyer, where, you're selling deals with 200-page documents that someone being paid $800 an hour has read, 50 times, right? And could tell you that the period on page 4 is an 11 type font, whereas the one it should be 12, right? And that's a real story, a true story. That is a very different type of securities offering than what you typically see in real estate, right? And that was the biggest, when I got into the space, the biggest thing I said, oh, like, I understand, like, this is very, very different, right? And so, it's important to make sure you're working with groups that are trustworthy, because deals are marketed based on forward-looking projections. I can make a deal on paper look however I want to make it look. And so you got to be a discerning consumer of your investments.
Yeah, and that actually is you actually almost answered my last one. Somebody, a high net worth investor who is listening in today, knows that only under very special circumstances can they invest with you. But they've not invested in real estate before. What advice would you give them as they start their journey today, particularly on deciding whether or not to invest in real estate online specifically?
Yeah, that's an excellent question. And I think the first thing is, it's a long-term game, right? You're not trying to find a single deal and invest in that deal and get the best return you possibly can. You're trying to create a sustainable system, right? And I think Warren Buffett said this, but I might be wrong. Like, investing is a game where patient people take money from impatient people, right? And I think that's true in a lot of aspects of life, but it is in real estate investing. And so spend the time learning about the group or the operating partner you're working with, right? And sometimes it's challenging as an individual investor, like you said before, because, even if I'm writing a $500,000 check 5 times a year, these billion-dollar portfolio sponsors have zero interest in my money, right? And they're especially not going to give me the time that I would want to actually genuinely evaluate that group. And that's where a group like us does come into play, right? Because in the aggregate, we're writing $5 to $15 million checks into any given deal, and with that comes a certain level of influence and involvement in the transaction. And so it's a long way of saying, be patient, invest in what you know. It's something I hear a lot. Don't get caught up in, the crazy new thing, even though I'll talk about cryptocurrency, for hours with anyone who wants to talk about it. But it's not, I view that as my gambling money, as opposed to, building a healthy financial foundation, right? And so I think that's the best advice I can give people. And then, look at the data, right? Look at the performance, compare it to what was underwritten, and over a period of years, you'll start to understand, if you actually put the time in to read and look at everything. And unfortunately, most people don't do that. But if you do, you'll learn it really quickly, right? If you're an accredited investor, you likely are sophisticated enough in whatever it is that you do to figure this out as well.
Daniel Cocca, co-founder, general counsel, and CEO, CIO, something else.
I'm managing director.
Managing director.
We just throw a bunch of titles on our business cards, and it makes me feel more important than I am.
Alpha Investing, what an enormous pleasure. I'm so happy we were able to catch up. It's been far too long. Thanks so much for joining me.
You got it. Thanks, Adam. Great to see you.
All right, that was Daniel Cocca, co-founder at Alpha Investing, one of my favorite people to talk to. I think it's very interesting, and I love his angle on behavioral economics, on the psychology of how people interact online, how they communicate, and how they engage in commerce. It's a very interesting area. I've already purchased his recommendation, the book Nudge, and I'm looking forward to that arriving and to diving into it as soon as it gets here. Thank you so much, Daniel, for joining me today. It is, as you know, always a pleasure. I enjoy talking to you. Thanks so much for your time. I know you're very busy. And thank you for listening in today as well. I hope you found the conversation with Daniel as interesting and as stimulating as I did. That is all for today. Oh, don't forget, go to gowercrowd.com and hit the news button. How could I forget to ask you to do that? At the top of the page, where you will find the most comprehensive source for news, updates, and information on commercial real estate, crowdfunding, anywhere on the web. All there at gowercrowd.com. All right, that's it for today. Be well, stay safe, and for now, this is Adam Gower signing off.